Good afternoon, ladies and gentlemen. Thank you so much for having me. It's a real pleasure and privilege to have the opportunity to talk as part of this summer educational forum at TEXPERS. And when we were first presented with the opportunity to speak here, we couldn't wait to jump at the chance to really discuss something that is very close to our hearts at this moment in time. And certainly this is something in an area, a topic of discussion that has had a tremendous amount of insight and indeed an area of focus for a lot of the institutional investors that we typically discuss with. And this is around the idea of trying to navigate dislocations. The way that I will, before getting on to the main topic of discussion, perhaps it would be remiss if I don't discuss a little bit about myself and the background of the organization that I work for. So I'm a product specialist and a managing director at Napier Park. I've been here for the best part of the last 12 years, and I'm very much focused on talking with allocators and investors such as yourselves around the key areas of credit investing that we tend to focus on at Napier Park. And so really looking at providing investment solutions, bespoke customizable accounts in some cases for our investors, and really trying to get to the hearts of their various needs. Napier Park, for those of you that are not familiar, is a credit alternative investment manager. And we have approximately 20 billion of assets under management, mainly focused on investments within the non-investment grade credit space. Where we have a particular area of expertise tends to be, and I'd say where our DNA is around the spaces and the intersection of where credit really meets structure. And what we mean by that is typically whatever we tend to invest in, we do so using a bottom-up fundamental credit research process. But that is overlaid with this idea of having decades worth of experience of investing within structured finance markets. Napier Park itself was established back in 2013, and it was spun out from Citi's alternative independent investment unit back at that time. And a lot of that was driven because of regulation and the fact that, I guess, banks at that time were no longer capable of holding stakes within businesses like ours. And we'll talk a lot about the idea of a changing regulation and secular change to our markets very shortly with regards to this idea as to why dislocations are relevant today. But just to finish on the organization as a whole, where we have expertise typically lies across both public and private market sectors, across the US and also Europe, and also across both the corporate and consumer landscape. So we have specialists of investments within areas such as more traditional single name spaces like leveraged loans, high yield, but also in structured credit in areas such as CLOs, CLO mezzanine, CLO equity, other structured finance areas such as credit derivatives, tranches on credit indices. We also have expertise on the consumer side through consumer ABS and mortgage-backed securities, and also in US municipal bonds, as well as specialty finance and European credit more broadly. Let's focus now on the topic of discussion, which is around dislocation. And just to be clear, what this is not a discussion on is an injury that you might sustain on the football field. No. We're here to naturally talk about market-led dislocations. And perhaps the only similarity that you can have between those two types of dislocations that I mentioned was the fact that both of them typically endure quite a bit of pain, right? But in the case of a market-led dislocation, and this is the thesis that we're working towards and that we've proven on a handful of occasions, is that actually it presents a tremendous opportunity, an opportunity for allocators and investors to take advantage of that market environment, a way in which you could potentially generate outsized returns and indeed, quite importantly, provide a certain level of insurance against the existing holdings on your portfolio. More on that to come. The way that I'm going to structure this actual discussion, I think, is going to come across four different ways. So firstly, we'll go through a little bit of the recent history and try and understand a little bit about what is causing market dislocations and why indeed we believe that they're going to be a feature for the foreseeable future. We will then look at the types of assets that tend to dislocate and which ones are more prone to dislocation. What are their characteristics? And how does this compare to other maybe credit-oriented strategies that you might already be familiar with? We will then take a look at understanding what skills, capabilities we believe are necessary to be able to take advantage of these opportunities. So what are the skill sets that managers and allocators need in order to get into those situations? And lastly, we'll turn it over essentially to yourselves. We want to understand what it is that allocators see in a dislocation strategy. How does it fit potentially within their portfolio construction? And how can it be additive and superior for them to consider an allocation to this space? Probably best to start with first principles. Well, what is a dislocation? And this isn't the dictionary definition that we'll be providing you with. This is the Napier Park definition, and really something that is important to understand what it is that we're here to talk about today. So what is a dislocation? It's really observed as a precipitous decline in market pricing. And this can be caused by one of two things. Either it's because of a market-specific stress or because of an exogenous shock of some kind. Exogenous shock, I think we're pretty familiar with these days. Obviously, the events of the last 2 years, because of COVID, we recognize that there are situations beyond our control that can occur that can impact financial markets. So these sort of left tail risk type events, perhaps you could call it a black swan type event. And then you've got market-specific stresses, example of which maybe in late 15, early 16, we had the energy, oil, and gas crisis. And of course, in that environment, it had a specific impact on those particular sectors, which had repercussions in different markets. But that's no different from what you already understand. That's just volatility, I hear you say. And what really distinguishes, in some ways, what a dislocation is through this third point. Well, it's marked, in our opinion, as a situation through which you have periods of liquidity interruption and disruption, which exacerbate these price moves, these precipitous declines in pricing that we observe during these times. And that is really at the crux of everything that we know and understand about dislocations. And then lastly here, what can it impact? Well, a market dislocation can be more broad. So in the case of COVID, as we highlighted, actually pretty much every single risk asset out there was impacted indiscriminately, and probably rightfully so. But in the case of something more specific and acute, then it can impact perhaps one or a handful of different markets. Nevertheless, bringing this all together, what we recognize is that this ultimately presents a window of opportunity for investors. And this opportunities generate very high and attractive levels of return. In these types of conditions and situations, when we've underwritten in market dislocations, we're typically doing so at a minimum of mid to high teens, and actually have achieved sometimes multiples of that level of return. So you can get an idea, an understanding of what we're talking about here. But ultimately, we also have to remember that there is no free lunch. You're typically investing in times of stress, and therefore it requires a certain amount of skill, expertise, and actually, importantly, discipline to be able to capitalize upon these situations of dislocation. And of course, we'll touch upon that later on in the presentation. So what we'll start with here is really in understanding why it is that dislocations are actually occurring. What is it that makes them something that will happen on an ongoing basis, and why we believe there'll be a feature for the foreseeable future. And so what we have here is a chart which looks at the bond holdings that banks have had over the course of the last, 15 or so years. And what we're really isolating this to is around the period of time following on from the global financial crisis. So our thesis here is that this idea of market dislocation is only something that has really started to occur following on from the onset of the GFC. And a lot of this comes down to regulation. Why is it that regulation has actually impacted these markets negatively? Well, in fact, the regulation that was put in place on banks was very much there to help safeguard against future global financial crises. But as a result, it's had a knock-on impact. And where it's had a knock-on impact is certainly in the area of liquidity. So what we have here on this chart is to show the level of bond holdings that banks have. And you can see that there's been a huge decline over those 15 years. You've had a 90% decline in absolute terms, and in relative terms, even more so, because these markets are even much larger than what they were back in 2007. This increased regulation has really had an impact in the sense that it's now much more costly for banks to hold on to certain types of assets. So i.e. to warehouse these assets and hold inventory of these assets. And actually where it's been more acute and where it's been more punitive for them to hold assets has been in two particular areas. The first of which is in lower rated tranches or lower rated investments. So where you have something that is sub-investment grade or non-investment grade, it tends to come at a lot larger and higher cost to banks than something that is investment grade. Also, they have a higher cost as it relates to investments or warehousing risk in areas which are non-core to their ultimate business. What is core to them? Well, it's lending. That's what banks are there to do. But as soon as you start to get off the beaten track and go into areas such as structured finance, this is where, again, they have a limited capacity to warehouse risk. So in those two key areas, it actually, produces a situation through which the amount of liquidity or the amount that these banks are able to step in and provide for is somewhat limited and constrained. This is important during a time of stress and volatility, because the way I like to think about it is that banks typically provide a safety net to financial markets. And that safety net is there that when you have stress and volatility, in the past, banks would have simply just stepped in and been able to warehouse risk at arguably cheaper levels than they would have had the opportunity to do so before. But what you've had now, because of this higher cost of capital, you've essentially had a removal of this liquidity buffer. And so once you've had the situation where you've had liquidity essentially pulled from under the feet of financial markets through the lack of participation of banks, that's where you have price overshoots. And this is what marks these situations of dislocation. Prices tend to distort much further than what they would have otherwise. A good way to corroborate some of what I've been saying here about this idea of the sort of pre- and post-GFC impact of volatility on asset pricing can perhaps be shown by looking at the VIX index. I don't have a chart of it up here, but I can describe to you the significant change that we've seen in volatility in markets. So the VIX index, as you may already know, is a measure of the equity market volatility for the S&P 500 index. And interestingly enough, in the 15 years running up to the global financial crisis, so from 93 to 2008, there were 9 separate occasions in which the VIX moved by 5 percentage points or more on any given trading day. Just 9. So that's less than one every year. Perhaps that's understandable. I mean, how often can a black swan event type happen, right? Now, look at what happened in the intervening period since the global financial crisis. And over the 15 years running up through to today, we've had over 70, that's 70 separate occasions in which the VIX index has moved by 5 percentage points or more on any given trading day. That's a marked difference. That's almost 8 times, if you're looking at it in a simplistic way, 8 times the level of volatility than what we experienced previously. And we would argue that a lot of it comes down to what we see on the page there. The other thing that's been happening specific to credit markets has been around the idea that there's been a secular change within our space more broadly. And this actually relates a lot to the idea that there's been a big change in the composition of the investor base within credit markets. The chart on the left-hand side here actually looks at the size and scale of these markets, both pre- and post-GFC. And this looks specifically at the sub-investment grade debt that is outstanding, both in 2007, but also through to today. And you can see actually there's been a tremendous amount of growth. These markets are roughly 3.5 times larger. They used to be at 2 trillion across leveraged loans, high yield, emerging market debt, and also private credit, and now extend to over 7 trillion in size. We have a hand up, actually. Hi. Yeah.
Quick question with regard to these 2 factors. Without banks making an active market in these things, the size increasing a lot, how do you see that impacting price dislocations when that actually occurs relative to what we saw in the global credit crisis?
So the question that James has asked is trying to understand a little bit about how much of a price impact I think has been seen as a result of the limited amount of liquidity that we've experienced. And actually, we're going to come on to that, so I'm glad that you've asked the question. And we have a chart that I'll come on to shortly to show how we've seen significant moves in pricing within particular types of assets. But needless to say, that we've seen severe changes to market pricing in assets which actually ultimately have an intrinsic and typically a par value in nature. But these assets have tended to trade off by significant percentages, in some cases by 50, 60, 70%, mainly because of the impact of liquidity, not because of necessarily a fundamental change or intrinsic value change. So we'll come on to that, and I think it's a really good question. But just to finish off on this, I think the idea is that we've had a tremendous amount of growth within our markets. Again, a lot of it is because of the withdrawal of banks, but actually it's because of the growth of a different type of investor. And over this period of time, we've had a significant amount in growth of holdings by asset managers, money managers, and hedge funds. So they've come in and stepped in and been providers of this credit where it's been most needed. In addition, we've also had a tremendous amount of growth through retail involvement, and that is shown on this chart on the right-hand side. We've seen roughly around a 250% level of growth through retail participation, and this is showing the level of US corporate bond holdings that retail have had over this period of time. This is between mutual funds, money market funds, and ETFs, and what's really interesting is, even on the ETF side, you can see here, which is shown by the gray shaded bar, that ETFs were roughly non-existent in 2007 as it related to their investments within, I guess, credit more broadly, but today have roughly around $1 trillion invested within the asset class. So again, you've had this changing of the guard. Before, you used to have banks, and actually even other institutions, such as insurance companies, who have now been subject either to Basel III or Solvency II, so the regulation that governs them, and that has restricted and precluded their ability to invest in these assets on a going forward basis, and have been replaced, ultimately, by these new categories of investors. Why is this all important? Well, let's try and summarize and understand what impact this is having. So as we've identified, there's a secular change to our credit markets, right? We've had this restrictive regime enforced on certain types of institutions and their ultimate withdrawal from these markets. And then you've had the inclusion of perhaps non-traditional investors. The retail investors that we've highlighted there have really been attracted to the space because of the higher yields that are available in credit. But again, there is no free lunch here. We have to understand that these areas have a higher yield premium for a particular reason. And again, it requires expertise over and above just looking for the highest yield that you can find. In addition, though, what we should understand is that the inclusion of these new types of investor groups have actually created two behavioral issues. The first of which is when we think about the hedge fund community now participating in credit, one of their, I guess, behavioral features is that they tend to employ a meaningful amount of leverage. We've seen that in equity markets and we've seen that in credit markets. That leverage that they tend to take up is either short-term or uncommitted in nature. And what tends to happen is that during periods of stress and volatility, those hedge funds are getting a tap on the shoulder. They're having margin calls because of the types of leverage that they've put on. And it's that ease of access to leverage that they've had that ultimately is causing a problem. Because when you have stress and volatility, they're actually enforced in a way to sell more assets to meet these margin calls. And I guess this creates a further unraveling within the process of a price dislocation. Additionally, the retail involvement through their daily liquidity funds, again, we've seen this time and time again, is that they're investing in assets which have multi-year durations, yet they are providing liquidity to their investors on a daily basis. There's clearly an asset liability mismatch. And what we've seen during these periods of stress, again, are sentiment changes by the retail investor group, outflows from those markets, which then naturally lead to the requirement for a forced selling situation by these mutual funds and ETFs to raise liquidity at precisely the time that they shouldn't be looking to do so. So really, it's the unraveling of both of those structural liquidity mismatches that I've just discussed that is at the precipice of what's happening in these dislocations. So now to almost go back to the question that was raised earlier on, this idea of what kind of situation and price move that we've experienced within certain types of risk assets over the last 15 or so years. And what we've put up on the page here is to really show two different price evolutions across a couple of different markets that we actually tend to look at. So at the top, we have the light shaded blue line, which refers to the traditional high yield market. And we also have the dark shaded blue line, for those of you that can see at the back of the room, which reflect the structured credit market, in this case through the CLO BB index. We picked these two because they're largely homogeneous, and they also reflect the same type of default risk, because they ultimately are a reflection of corporate risk. And they have a similar rating profile. But I think one thing that is obvious and observable from this chart is that the structured credit market, during times of stress, which we'll come on to what those periods were, have experienced a significantly greater degree of drawdown than perhaps what we've seen within traditional high yield. And on average, we've seen roughly 2 times the level of drawdown within structured credit than what we've experienced within high yield over this period of time. But importantly as well, as you can see from the green arrows, recoveries have actually been fairly quick and sometimes quite swift, but also very meaningful. And the way I like to think about it is that if you had an asset that was worth par previously, so at a price of 100, and then all of a sudden, because of a market dislocation, it was then priced at a value of 50, say, you've naturally had a 50% loss on your holding. But the opportunity to invest at that point, and for that asset to recuperate close towards its par value, allows you to potentially generate 100% return on your capital, going from 50 to 100. And this is the premise, again, behind this idea of investing appropriately in dislocations to generate very attractive returns. You can also see that there's been a handful of different dislocations just within this period of time. Obviously, it started with the global financial crisis in 2008, but in 2011, you had the US debt downgrade. Equivalently, in Europe, you also had, at the similar time, the existential threat to the euro and the sovereign debt crisis across the Eurozone. In 2013, you had the taper tantrum. In 2016, you had the energy crisis that we referred to earlier. And 2020, of course, you had COVID. More recently, we've had the start of a potential other dislocation, and this is why we've been having a tremendous amount of inquiry around this particular topic, because of the moves that we've started to see in financial markets, particularly over the first 6 months of this year. And there's taken a brief pause, clearly over the course of the last month or two, but certainly something that can rear its ugly head again going into the latter half of this year. What I wanted to address now is we've spoken about sort of structured credit as potentially an area that tends to over-dislocate, an area that has experienced more significant price declines than perhaps other traditional spaces. But one of the things I wanted to demystify, and sometimes we get questions from investors and allocators around, well, how does this compare to something like distressed debt? Are these two things one and the same thing? And actually, what we hope to be able to do here is to distinguish categorically between the two and show that they are distinctly very different from one another. When we think about an investment in a dislocation, and I'll just get back to the right page, hopefully, and which is really shown by this particular column, what we're looking to do is to invest in assets that are cheap whilst the market is trading cheap. For something like distressed debt, it's actually very different. What you're trying to do within that strategy, and I'm not the expert on this, but I hope to provide a brief overview, is that you're looking to invest within a stressed asset, something that is trading cheap because of fundamental reasons. It is undertaking a significant or experiencing an element of stress, and you're able to acquire debt within that company at a cheap price, but for very good reasons. And the goal of that strategy is ultimately to be able to restructure the business, take equity ownership through either a bankruptcy process or otherwise, and then go through an operational turnaround over multiple years to then try and create a multiple of return. And that's very different from investing in a dislocation. Again, remember, what we're investing in are performing assets. These structured credit assets, they may not have necessarily a good name over the years, but have actually performed tremendously well. They just happen to go through periods and bouts of volatility. Again, presents itself potentially as an opportunity, but they are performing. And when it comes to underwriting these assets, what's very crucial is that you can underwrite to contractual cash flows. These assets have defined coupons or distributions that you can underwrite towards. And importantly, they also have a known outcome of some kind. Remember, these assets have a par value. They have an intrinsic value. They may actually be underwritable to a specific amount of impaired loss, but you can acknowledge what that value can ultimately be. Again, in the case of distressed, very different. The outcome, who knows? It's more equity-like risk in nature, whereas within investing in credit, you understand what the risks are, but you also recognize what the returns can be. And the other distinguishing feature, which perhaps makes these types of, I guess, opportunities between distressed and dislocations maybe complementary, is that with distressed, as we highlighted, it can take numerous years to actually go through that operational turnaround. So the returns are accreted over a much longer time period. In the case of dislocations, as we saw on the prior slide, those kind of recoveries can be quite quick. We've seen them occur within the space of 1 to 3 years on average. And so the time frame to being able to generate the returns within a market dislocation can actually be quite compressed and therefore quite attractive. So let's turn this a little bit over now to understanding a little bit about how we think those that are participating in market dislocations need certain skills and capabilities in order to invest in these particular areas of stress and market dislocation. And there's 4 key things that we think are sort of almost alpha generators in some ways to being able to invest in market dislocations. So firstly, you need an expertise. It sounds quite trivial. Of course, you need an expertise in investing in areas that are prone to dislocation. In the case of Napier Park, as we've expressed, we actually have a tremendous amount of experience of investing within these types of assets. We have approximately 30 years on average through our senior investment professionals across the areas that they have expertise within in investing in these markets. And that's important because there's clearly an understanding here that it takes a degree of stress to get markets volatile and moving in a particular direction. So clearly there is an element of fundamental change which is occurring, which is causing these prices to move. But understanding where that level cuts off and perhaps where it kicks in, that you have more of a technical stress, i.e. because of this disparity between demand and supply dynamics and because of this overshoot in pricing because of liquidity conditions, is what's absolutely necessary here to be able to underwrite in these circumstances. Secondly, you need a disciplined investment process. Now, again, that sounds pretty straightforward. I don't think for a moment anyone within this room is allocating to a manager who throws a dart at the board and hopes to be able to find the next place to invest in. Of course not. But what I'm referring to here is specifically within the context of a dislocation, you need absolute discipline to be able to enter the market at precisely the right time, and not only enter the market, but also to exit your investments at an appropriate time too. So this is actually very crucial, because one of the things that we get asked all the time is around this idea of, well, look, there's a period of market stress. We might be going through dislocation. What is the risk that actually you're going to be investing at a time when you could be catching a falling knife? And this is why discipline and rigor is incredibly important. Some people like to allocate perhaps an idea of having a trigger. Perhaps there's a price level at which you might want to invest. So if an asset falls to a price of 70 cents on the dollar or below, that is a time to start investing. Or equivalently, if an asset is trading at a spread over and above, for example, 800 basis points, then that's a time that you should be looking to invest in these assets. That might be instructive in some ways, but we actually wouldn't look at it that way. Each and every situation requires its own determination. And the way that we tend to invest is through utilizing a lot of stress test cases. We go back in history and look at default scenarios that may have occurred during different situations and try and overlay them onto the positions that we might be looking to invest in or are continuing to invest in, to understand if we can invest in these situations quite conservatively. Invariably, what we tend to do is to look at very stressed cases, and in those cases are hoping to be able to generate a return that would at least preserve our capital, given the nature of the environment. But should those not manifest, which typically tends to be the case, then you can actually stand to generate very high returns. The third point here is around sourcing. And this is important because, as we've established earlier on in the conversation, banks are no longer providing these two-way markets. So actually, where are you going to go to source these types of opportunities, particularly because liquidity is quite thin? Well, a lot of it comes down to, over the years, having established private and bilateral sourcing channels. And this is something that we started to do very significantly following on from our spin out into Napier Park. We recognized the situation that we were in. we acknowledged that banks were no longer going to be the source from a lot of these assets, and therefore it was incumbent upon us to start developing relationships across the field. And a lot of the opportunities that we've started to develop and have invested in, following on from those dislocations that you saw, have actually come through our direct relationships with a number of different participants within the market. So essentially disintermediating the banking community. And then lastly here, active management capabilities is the fourth point. Well, active management is always important, but I would say within the case of a dislocation, it's even more important to generate return. And the reason being is that, in the way I like to think of it, is that during a broader period of dislocation, you tend to have many pockets of mini dislocations along the way. Not every single asset class in structured finance will react in exactly the same way, bearing in mind that you might have, like we do, an ability to invest across different types of areas, whether it be on the consumer side or the consumer side. And in those circumstances, it means that those markets may be impacted very differently from one another over a longer period of time. And it's the unevenness of the recoveries within these different spaces that promote the opportunity to be able to rotate risk within the context of an overall dislocation. For us, through our experience, and in the last dislocation that we participated in, we actually generated over 50% additional return in our dislocation strategy, more so than what we would have had we just simply bought and hold on to the original investments that we made. So I think that is an also very important source of, I'd say, alpha and consideration in being able to extract the highest level of return. So now let's switch gears a little bit and go back to what this all means for you as allocators. So what are the two key reasons that investors are looking to start allocating within dislocation strategies more broadly? And we've highlighted this as we've been going through the presentation, but a good way to sort of summarize on it. We've acknowledged that it allows allocators to be able to generate very high levels of return during these times of stress. And again, the fact that these returns can be generated within a shorter period of time is something that is quite attractive to them. But secondly, and I think this is the most important part, and perhaps for the investors in this room being pension funds, a lot of the pension funds that we talk to certainly look at it more as a way to be able to provide insurance against their existing holdings within alternative credit investments more broadly. And that's because a lot of these investments, as we know, will be subject to that mark-to-market that they will experience during those periods of stress and vol. But by being able to access these dislocation opportunities, it means that ultimately you can have an island of green in a sea of red. So during those times of stress, having the opportunity to have something that will help to dampen volatility and smoothen that volatility is seen as a very positive part of their overall portfolio composition. And the other point to make here, and that we haven't really discussed, is this idea of how do actual investors participate within these situations, in what type of fund structure? Well, typically it's in the format of a closed-ended vehicle, one that I'm sure that you're probably familiar with, in that you'll have a commitment that the allocator will make, and then the manager will elect to find the appropriate time, following on from a dislocation, to call on that capital to invest in dislocations. You'll then have an investment period, typically lasting around 2 years, to be able to invest and then rotate those investments as we discussed. And then following on from that, another 2-year period or so through which you can harvest gains from those dislocations, looking for really a rebound and a normalization in liquidity conditions and an ability for those investments to ultimately recuperate to the levels that we think reflect their intrinsic or par value. How would this also look in the context of your overall portfolio, and what can it do for your overall risk return? Ultimately, that's the name of the game here. And what we've done is that we put together a sort of illustrative analysis to show how your portfolio could be positively impacted from a risk return perspective through an allocation to a dislocation strategy. And the way that we did that is that we took an investment that could have been made, and what we call portfolio A here, in structured credit, so again, utilizing that CLO BB market that we expressed earlier on before, and to take a look at what the performance would have been had you invested within that asset class over a 2-year period, straddling either side of a dislocation. So we conducted this analysis looking at the period starting in January 2019 and ending in January 2021. Obviously, slap bang in the middle, we had the COVID disruption. And had you invested in the CLO BB area, you would have actually still positively generated a 9% annualized return during that time. A lot of that comes down to the V-shaped recovery that we saw during COVID. Not something that we think we'll see again, but nevertheless, that was the return that you would have generated. However, you would have had a lot of blood, sweat, and tears at the same time, because you would have had to have encountered and experienced an 18% level of volatility during that period. Now, what could have happened if you had allocated to a dislocation strategy alongside this? So instead of having 100% allocation to structured credit, what if you had said that, actually, I'm going to take that investment and split it into two. I'm going to have a 75% allocation because I need to have money in the ground. It's very important to understand that allocators cannot simply be sitting in cash all the time. We recognize that. And therefore, why not have 75% invested in that space? Ultimately, we know that we have to experience some volatility, but also have a 25% allocation to a dislocation sleeve. What does that do to your overall return? Again, running through that scenario, what it actually would have done was to generate and allow you to generate a return of roughly 2 times, so an 18% annualized return over that period, a 2 times level of return that what you would have had is simply investing in that market in full. At the same time, you also would have helped to reduce the volatility within your portfolio by 1/3. So again, hopefully this demonstrates this idea that actually one should maybe consider an allocation to dislocation strategy. Why? Because for all of you modern portfolio theory guys out there, we all recognize that there's this idea of trying to reach the efficient frontier, i.e. trying to get to a point at which you can generate the highest level of return for the lowest amount of risk. And so I would argue that through inclusion of a dislocation sleeve within your overall portfolio, that is more achievable. And lastly, to conclude and to summarize, one of the ways that we can try and express this by way of conclusion is by looking at some of the goals that naturally allocators have when it comes to investments more broadly, and see how a dislocation sleeve or strategy might be able to help them attain those goals. Some of these that we've spoken about through the presentation, but a nice way to summarize. So as we've said, one of the key goals I think for allocators is to preserve capital. And we recognize that by an allocation through to a dislocation sleeve, it allows you to provide this sort of insurance, as we call it, across existing holdings that you may already have within this space. Again, it helps you to generate high returns. There's nothing to balk at in looking at trying to generate very supernormal type returns during a period of stress. It allows you to be opportunistic. We recognize that these situations are becoming more frequent, perhaps once every sort of 2 to 3 years from what we've seen following on from the GFC. So an ability to take advantage of those opportunities when they present themselves is an important thing. And lastly, it's this idea of being prepared. And we think that this is really the crucial part of the discussion. In that, and I'll use an analogy to help try and describe this, in that I don't think anyone here would be looking to pick up the phone to their insurance company whilst their house is on fire. And what I mean by that is, similarly here, there is no point trying to allocate to a dislocation strategy following on from the onset of the next dislocation. The reason for that is that we've seen this time and time again, and certainly when we've been speaking to investors over the years, when they were first considerate about making an allocation to a dislocation strategy, they'd come to us and say, look, I get exactly what you're talking about. This makes a lot of sense for us. But how about when a dislocation occurs, you come over to me and I'm happy to have the conversation and I'll absolutely allocate to your strategy. Needless to say, how did that actually pan out in reality? Well, tell you what happens is that a dislocation occurs and you go and speak to that investor and they're saying, great, this is exactly what we were waiting for. They understand the concept and the idea. They go back naturally to their investment committees, to their boards for approval for a strategy like this. And I can assure you 99 times out of 100, if not more, would come back and say, we're not getting approval for that. And I wonder why. Because can you imagine during a period through which an allocator is looking at their investment portfolio, having to put out various fires across those different aspects of their portfolio, and then trying to ram through this idea of investing in the market at that time, it's just not going to fly. And that's why it's important to be prepared, as we say, because it means understanding the nature of these dislocations, recognizing that it's almost not a case of if, but when the dislocation or the next dislocation is going to occur. And when it does, having the opportunity to be partnered with an organization which recognizes what's going on, can understand the disparity between fundamental stress and technical stress, and having a process around being able to invest in these types of situations. And so with that, I'll conclude the presentation, and thank you for your time, and we'll open it and open the floor to questions. Thank you. I think a question over here.
Sure. One other question, one observation. Not only is it hard to get approval at that point of dislocation, but the time lag make this the opportunity altogether.
Look, this is a very important point. Look, it's very clear that during the initial, and sorry, let me rephrase the question for those that may not have heard. But James there was referring to the fact that following on from a dislocation, if anyone was trying to get approval from their board, and let's say they were successful in doing so, is it the case that actually you may have missed out on a significant portion of the return that could have been generated during these periods? And it's an interesting question because it depends on the nature of the dislocation itself. And that's because if you're using the example of the COVID dislocation that we had more recently, then in that situation, then arguably you could have missed out on a substantial amount of return. Why? Because, of course, we saw things fall through the floor pretty quickly, pretty precipitously. And therefore, if it had taken you a significant amount of time to get that approval, you might have missed out on some of the initial opportunities that we started deploying capital in. That said, again, given this idea of being able to rotate capital and invest in different situations, we actually found our largest performing or highest performing investment came not in March when we first started investing into that dislocation. It came actually at the end of June in an investment that we made at that time, again, because of a disparity that started to occur in a different market. I think if we're looking through now to, I guess, what's relevant today, the types of dislocations that we're likely to see are not necessarily going to play out over a shorter period of time. So whilst it is important to be able to access the first opportunities, it's not necessarily the case that you won't be able to achieve a high level of return from investing perhaps in the second or third innings of a dislocation. So I think it's more of a case of it depends. And it's very hard to sort of paint every situation with the same brush, because a lot of the time we're now encountering situations that we've not seen before. But the only thing that kind of envelops itself around these opportunities is that we know that liquidity will evaporate during those times, and that ultimately will present an opportunity to buy into assets at much more attractive levels than perhaps what their ultimate residual value should be.